But the one thing that I think the markets would be pretty keen to understand is if in your mind, the company's kind of past that point of minimum cash balance.
Feed grade was up to 1.8. We're well up from the sub 1 grams. Is that what you're going to be trying to achieving long term? All right, g'day, money miners. It's weekend time. Are we coming to work on Monday, Trav? Markets are closed.
They closed on Monday.
Yeah, because it's a public holiday over East. King's birthday.
Mate.
But it's not a public holiday for us. Ooh, yet to be determined.
I love the monarchy.
Money miners. So, yeah, I do love that's the best thing about the Poms. Love it. Now, Mr. Ricciardo, this Friday, now we talked about this a couple of days ago. We're not going to go over all the other news for the day. We've got Mark Williams coming on, MD of RED 5. RED 5 obviously been well publicised of their, grade ramp-up issues, multiple raisings.
Yep.
But there appears they've had a good few months. They've definitely, especially the last 2 months, they've produced 18,000 and 19,000 ounces each of those months. Recoveries are lifting, grade is lifting. They're hitting the sweet spot of the pit, it appears. We're going to give a bit of a briefing, go over what we think and stuff we'd like to hear from Mark. And Mark's going to come on and have a yarn about it. So
looking forward to it, mate.
And as we always say, especially going through this whole period of what Red 5's doing, absolute credit to Mark for wanting to come on. So
yeah. We've talked about this company before, and it's been, in some ways it was an unfavourable colour, and big credit to Mark for coming on. I mean, the company sort of put out some, consistent turnaround sort of announcements, but big credit to Mark for coming on today. Really appreciate that.
Right, let's get into it. So, okay, the May update, King of the Hill produced just over 19,000 ounces. In May, 350,000 tonne of ore processed at a head grade of 1.8 grams per tonne. End recovery of 93.6%. So all of that is on the up, because if you look at the graph we're showing here, that red line there is the head grade going through. So you look at what's actually so that month, I think they're averaging about 1.7 and a bit for the Q4 to date. This month produced 1.8, so there's a good lifting grade. With that grade has come better recoveries, come more ounces. It's definitely on the up. So definitely getting towards, because you look at sub 1 gram.
This is the announcement that dropped on yesterday, and the 7th, on the 7th.
Yeah.
Gotcha.
2 days ago, I think.
Yeah.
I think it come out. So look, they did have a 4-day planned mill shutdown, and they did have one in February as well. So it looks like they'll probably be having them quarterly, which is some do them halfly, some do it quarterly. So I'm not sure. Not too much of a processing guru myself, but bigger mills need bigger maintenance. So this 4-day mill shutdown is a planned thing to make the thing humming. So even with that 4 days of zero mill production, they still got increased ounces. So because if you look at looking at their capacity, Trav, they said it's a 4.7 million tonne per year plant. Yeah, so you look at that for 4.7 million tonne per year. It's been running at 4.8. So 4.8 million tonne a year is 13.1 thousand tonne a day. But if you look at what the material they've put through in April and May, so May they got 12.96 thousand tonne a day. So that was with 4 shutdown days. In April, they got 13.3 thousand tonnes a day. So they are exceeding that, hanging around that 4.8 million tonne. I think May that includes I did that on 27 days. So they are sitting at that 4.8. They've talked about expansions of that mill.
It's a pretty marginal expansion though, right?
Yeah, up to 5.5. But I suppose you think in their situation, because it looks like they're producing more dirt than they're milling. They've got stockpiles on the ROM. I suppose looking at that hedge book, just upping that, getting the benefit of any little extra ounce you can get to get it unhedged.
Because the dynamic of that is that if you're just producing more ounces earlier than their proportion hedged, is lower, and you just have a higher average realized gold price across your hedge book and spot.
Yeah. So they'll get, because it's you look at pretty much half of their gold is hedged, a little bit under.
Yep.
And look at 2270, 2260, 2221. So pretty. I think Q4 coming up is 2309. So they're obviously missing out on
That's Aussie
700.
dollars per ounce, right?
Yeah. So they're missing out on $700 an ounce there. So look, I guess the open pit's that's the big humdinger. I think for that 4.7 million ton, like three of that's coming from the open pit. Like most of the tons are coming from the lower grade open pit. So because you look at this grade distribution they've got, and you see you look at the previous quarter grades, like getting to below 1 gram. You can see how they've gone through that top shitty part of the pit, where that grade, so that 50, it sounds like the good stuff starts at that 52.15.
What am I looking at here, Matty?
Oh, this one here, Trav. So see that.
How do you the photo. How do you explain that?
So that is each level RL of the pit. So look, you think of the pit as a big bowl. So those RLs, in between those, they're just taking a slice. So
what's an RL?
RL, it's just the height.
Okay.
So
it's like another layer of the pit. Is that what you mean? Like,
so like if you're at sea level, it's 0.
Oh, it's just a metric.
Yeah, it's the height.
Meters or something.
Yeah, the height. So they usually do it. So if that's 52.25, that would be sea level plus 5,000 meters. That's how mine sites calculate it. So they don't go into negative. So so that means that place in the world is 225 meters above sea level. So
the ounce distribution, they've just gotten to the depth now where you get,
you get a lot more ounces.
The patch where there's the highest ounce density per vertical meter. Is that right?
Yeah, exactly. Yeah. So you can see they've gone through the top bits there. There was, bugger all. But whether that's to do with actually having to take a big footprint of the pit at the top, but I think they've just done a cutback as well. So and from what I've heard, they've just got through all the oxide, and they're getting through, and it mentioned in here, they got through that granodiorite contact, which is, I think, the contact of the ore body where most of the gold is. They've got through that. Now they're in the fresh, in the better rock. So
Matty, I got a question for you, right? So I'm looking at this vertical ounce density chart, and it gets to the top end at, where are we now? 5215, right? And it stays at that sort of chunky top end all the way down to about 5165. So how long does it take to go to mine that 60 odd vertical meters there?
Right. Well, it depends on the schedule, the rate they're doing it, the geometry of the pit. Being more an underground man, I could do some back of the envelope. What do you got there? Look, the back quarter would be in the last 3 or 4 years, or 3 years of that 15-year mine life. So they've got 63 million tons in reserve in their open pit. So, and they're going to be putting about 4 of that through each year. So that's where the 4 million ton of the open pit. So, but then once you get to the bottom, to get that last bit out, depending on when they do the cutbacks and everything, it might take ages to, do the cutback and access that bottom part of the pit. So I couldn't give you an accurate answer there, Trav.
No worries.
I guess for the foreseeable future, in that big chunk there where you've got most of the ounces, and 90% of those ounces are high grade ounces. That's the red bits. It looks like it's they'll be in a bit of a sweet spot for a while there, going through there. So at the back end of the mine life, obviously it looks like to drop off. So, but you look at, I guess what you'd like to see at this operation, like you're getting the big tons from the open pit, but any little extra ton that you can get out of underground, because that's where the grade is. So you look at their grade in the open pits, 0.47, 0.65, 0.85 for the March quarter. It is lifting up, but you look at the underground grade, it was 1.58 in the March quarter, and the reserve is 2 grams for the underground. So I'd be keen to ask Mark about that when we go, I guess, see getting towards that 2 gram reserve, because what's in the reserve should be coming out, because that's taken into account your dilution and everything like that. Is the reserve grade should be what is coming out of the hole. So I'll probably be hitting him up about that. So, and getting more out of underground be pretty handy. So I guess where do you see it, Trav, with the I guess after everything they've been through, and are they sort of in a tight position for cash? Like, are they going to be needing to raise again, or like are they? Where do you see them sitting?
I think that's the big question on my mind, right? Is the companies really relied a lot on equity markets at times when shareholders, were thinking that the last raise is done, and so you just hate to see another equity raise here, Matty. So the fact that they're into that high grade stuff, I'm just doing a little bit of math based on the cash flow dynamics that we know are at play. So they ended the March quarter with $23.4 million of cash, but we know that $32 million came in the door in April, and that was tranche 2 of the placement that they did in February, plus the SPP as well. So that takes it up to $55 million cash balance. So then you subtract what we know they've got to pay to service their debt, because they got a fair bit of debt, right? So there's $7 million repayment off the project finance facility. They got to repay the working capital facility in full, so that's $15 million. And my estimate is about $3.5 million of interest they've got to pay as well in this June quarter. So, because their project finance facility is at BBSY plus 4%.
Yep.
So that takes us to $30 million of cash as a bit of a buffer there. Hence, we sort of need to see, in my mind, positive cash flow in this June quarter. Otherwise, things will be getting a bit stretched. And this is mainly an OPEX thing, Matty, but I suspect there'll be a little bit of CapEx that falls into the April quarter as well. We know they completed their TSF 5, so Tailing Storage Facility 5, in the March quarter, and that was signalled. I think I had growth capital provision of $5 to $10 million for this half. So let's just assume $5 million falls into the June quarter. There, that takes us to $25 million cash buffer when we isolate the OPEX alone. So, or when we isolate the operating cash flows.
So it's very, it's very dependent on squeezing as many ounces out of the joint as they can and keeping the costs where they're at. To, as you said, just to increase that buffer. It's just that they're at that point. It's like they wouldn't want to go into. You can imagine how the market would react if they add another raise on top of the ones they've already had.
Yeah,
so
and we can run some back of the envelope like calcs on the operating cash flow side of it. I mean, so they've maintained their guidance publicly of 90 to 105,000 ounces for this half. In March quarter, they did 41,000 ounces. So in April and May months, they did 19,000 ounces each. So let's assume they do 20,000 ounces in this month of June.
Which would be another record. So
just as an assumption, right? So that's 58,000 ounces for the June quarter total. So if you now you say they have to deliver 26,000 ounces of that at $2,309 per ounce. That's their hedge book, right? So they have to deliver that many at that price in that quarter. So let's assume the remaining 32,000 ounces sell for $3,000 an ounce, which is, spot gold is hovering about that, right? That's an average realized total gold price of 2,700 per ounce, that'll bring in the door 150 million Aussie dollars.
Yep.
So the real question is just going to be like, what's the cost of those ounces? Because even with the high hedge commitment there, getting an average realized price of 2,700 is still pretty healthy, right? And they've gotten in the high grade stuff. So, it's looking like they could be over the hurdle there, but which is really like, it'd be a really positive story if they are over the hurdle there. Everyone wants to see it. No one wants to see another developer, struggle. So, but I think the one piece of information in my mind that I'd be pretty keen to learn about though is just like what their debt covenants are, because their debt facilities, there's certain covenants around having, coverage ratios and minimum cash balances and things like that. And those covenants will largely dictate the need to raise more equity in my mind. And I can't, I've had a look, but I can't find what those debt covenants are.
And the thing that just strikes me about this operation, just in its current state, like as we said, looking at the grade in the future, and once the debt pays off, it looks like it probably could generate some decent cash when everything gets humming.
Mm-hmm.
But the position they're in at the moment, it's like they've just got no room for error.
Yep.
Like no room for operational error. Like God forbid a bloody significant weather event. I suppose they're in a better, at least they're not in the Pilbara exposed to cyclones and everything. But like, it just seems they really need everything to go smooth, go right. And which is, look, that's a lot of pressure on a company and an organisation. So
there's one, and like to your point on, needing everything to go right, I think there's one funding lever that they still have, which would, it would actually enable them to avoid diluting shareholders again and going into the equity markets. And that's the fact that they have this royalty over Siana, the gold mine that they sold. They retained this royalty. I ran just some calcs on what I think that royalty could be worth, and on my numbers, it could be worth about 30 million Aussie bucks.
So is that if they sell it?
Yeah, and there's heaps of TSX listed royalty companies out there that are literally.
Is that one over here to Terra or?
Oh, but they don't buy gold. Well, they only have one real royalty.
Ah, right.
The TSX ones are like they own a bunch of gold royalties, and then it's like Franco and stuff like that too. But there's heaps of places that would buy a gold royalty.
But they're that mine's only just got back and restarted, isn't it? So they'll be still waiting to get the benefits from that.
They're expecting, I think, like a 200K payment this quarter from it, which is like small, but it's in ramp up, and it's it's got a pretty steady it produces about 60,000 ounces per year for about 10 years, and they've got, I think it's a 3.25% net smelter royalty there,
which is pretty high, huh?
Yeah.
Yeah, because it's a net one. And that wasn't available. Was that always sitting in the background when they went through the two raises earlier this year? Like, was that royalty that was just sitting there because that mine wasn't in production? I suppose they could have sold it.
Yeah, they could have. I mean, it's, I think they could have, but yeah, I'm not sure. Like, there's also tax implications as well, right? Like, if you sell something, you got to pay tax on it. Sometimes you got to hold it for a period of time to lower that tax.
Yeah, I guess, look, commentary from the brokers and money houses and that. Look, Argonaut, as you know, Johnny Mack had a sell rating on them for a while. So, but look, they're saying that if costs hold for this to where they were for the December and March quarter, and they produce another 19,000 ounces this month, that'll be a break even for the quarter. It sounds like they're predicting they need to get over that 19,000, actually generate some free cash. Canaccord, they're projecting, I guess, going forward from here, they're projecting they're going to be around that 209,000 ounces for 24 and 25. And Urals Hartley's have them projecting to do 209,000 ounces a year for the next 2 years. So, look, at this 19,000 ounce run rate, you would see 19,000 ounces average is 228,000 ounces. Though that's 1 month, like month where, look, they did have a mill shutdown, but it seems like if they can get up and exceed that, that's what they're going to need to make this whole thing work.
Yep, let's hope it all comes together, Matty.
Yes.
Let's speak with Mark.
Righto. Let's get him on the blower, Trav. Well, money miners won't lie that this is a big smoothless operation, and we had him here already because we didn't. We've got to cut to it. So let's cut to it. Right now, money miners, we're going to expand and provide a bit of additional insight to what Trav and I have just discussed with Red 5, and who better to do it with than the main man himself, MD of Red 5, Mark Williams. Mark, very pleasurable welcome to Money of Mine, mate. How are you, Cobber?
Yeah, good. Thank you, Matt and Travis. Great to be on the show today.
Mate, thanks for coming on. We do appreciate it. We understand it's been a bit of a rocky journey, and we always are grateful, when you come on the show amid that sort of background.
Yeah, so, and you've had a good, I guess, on the back of a good couple of months, you just put out your monthly update, which we just previously discussed. 19,000 ounces. Looks like you're getting into the better part of the open pit. Mate, give us a bit of, I guess, additional insight of where the King of the Hill operation's at.
We've obviously been targeting the main part of the ore body, and we started mining at King of the Hills in January of 2022, and it took us just over 13 months to get to this main part of the ore body, and we were a few months later than we had expected and hoped for. But since we have hit that prime part of the ore body in February, it's really been a major inflection point for the project, providing us excess ore tons than we can process, which has had a number of downstream positive impacts.
And is the big driver of that, Mark, that you got through was it like a surface oxide and now you're into sort of the fresh high grade material? I saw in your quarterly how the grade distribution is once you hit, I think it was the 51.25 or 52.25 bench. It really looks like thin grade and the tonnage of it's going to start amping up for you. Is that where you're at the moment?
Yeah, that's exactly right. So we've had a cutback on the open pit at King of the Hills, and it's been about a 50-meter vertical cutback, and until we hit the prime part of the ore body in that 52.25 level, and the ore opens up considerably and the grade improves considerably, and that's what we hit in February, and that's the significant inflection point for the project.
That's great news, mate. The and I think one thing everyone's probably curious about, and you've surprised the market to the upside on the production numbers, especially given the the mill shutdown in the last month as well. But the one thing that I think the markets would be pretty keen to understand is if in your mind the company's kind of past that point of minimum cash balance, and it looks like cash balance is sort of trending upwards, notwithstanding there's some debt repayments this quarter.
Yeah, that's right, Trav. So since February, we've had those 3 really positive months, and as I said, June is looking also very strong, and those months have been cash flow positive, and so we are building up our cash position.
Yeah, with the grade, Mark, you just look at that good ascending line we can see in your presentation, like your feed grade was up to 1.8. We're well up from the sub 1 grams from Q1 in FY23. So is that now you're at that good point of the pit, and you probably might be able to give a bit of additional insight into the underground? Is that sort of that head grade what you're going to be trying to achieving long term?
Yeah, I think that as I said at the introduction, all 3 mining operations, being the 2 undergrounds at Darlow and King of the Hills, plus the open pit, are running really strongly. Darlow's in currently a sweet spot. We've invested quite a lot of money into Darlow historically, and that's really performing well with some new mining areas, particularly the Middle Water South, that's coming through. King of the Hills underground has also hit its straps. Got a great team there in place, and they've had a number of strong months. That combined with the excess ore tons that we are able to mine from the open pit means that we're able to prioritise the best grade, and that's enabled us to deliver the last 3 months where that grade has been ticking up. With June, we are expecting a full month of production with no shutdowns. So I do expect the grade for June to drop somewhat compared to May's number, but we'll have greater throughput in the way of the tons, and the ounces at the end of the month are looking forecast to be very strong.
And what about the underground? You've got a 2 gram per ton reserve grade, and it's sort of been tracking a bit below that. How's the future of the underground looking? As better grade coming on the way as you go deeper and access other areas, or when can we expect the underground grade to sort of lift up to that 2 level?
Yeah, we're seeing that coming through last month and this month, Matt. So we're expecting that to continue from here on in.
Nice one, mate. We've found ourselves pretty what we call balls deep in the Leonora story right now. We're
Very much so.
Where I bloody bought St. Barbara shares the other day.
You might have been balls deep at some point too, Mark. Probably last year. I was saying.
Now Red's thrown in the mix and the announcement mix and everything like that. And I think like the way that we're looking at that area is it's sort of okay. There's a big consolidation play, and now Red's right in amongst it, and there's a big 5 million tonne per annum plant that you talked about, which has a bit of strategic importance, not just for the King of the Hills operation, but potentially more regionally minded as well. I'm kind of keen to sort of, I guess, get your perspective on how you think about the infrastructure and the assets there in the context of that Leonora consolidation story.
Yeah, well, with Red 5. Currently, we're a very simple story. What we're focused on is delivering what's in our control, which is delivering against our targets safely, efficiently, and cost effectively. And we believe continuing to do that will deliver significant shareholder value. So really, that's what we're fully focused on currently.
Played it back with a straight bat, Matty.
That's all right. Well, at least we got to ask it. The expansion project, Mark. So you had a 4.7 million tonne capacity. You're exceeding that on your mill. You're pumping the tonnes through it, and I see there's an expansion project in the mix, looking to increase the throughput up to 5.5 million tonne by FY24. So I guess, can you give a bit of context on that? I suppose at the lower grade end of the spectrum, additional tonnes will be very handy for the ounce profile at these prices.
Yeah, that's exactly right. We're looking to lift our throughput from 5 million tonnes to 5.5 million tonnes, and the majority of the work has already been completed for that. So there's a number of activities that we've been working on very, very hard in the background, completing the construction of Tailings Storage Facility 5, which we moved over and started depositioning in April. That's a shorter run compared to TSF4 and has backed off the pressure on the tailings pumps, and that will help us to lift the throughput. And there's a number of other additions that we've already put into the mill, increased size of motors and pumps, and so we're looking really strong for FY24 to be able to get that circa 10% uplift in throughput of the processing plant. And as I said, we can currently mine more tonnes than we can mill. So really that would be a really strong addition for those ounces once we are able to get up to that run rate of 5.5 million tonnes per annum.
So because it said you've already got a 6 million tonne crushing circuit there already. Correct me if I'm wrong with any of this. So it's most of the additional throughput just do you need extra tanks, leach tanks and things like that, or is it just little tweaks here and there to get that extra bit?
Yeah, so we don't need any. We do not need any leach tanks additional to get to that 5.5 million tonnes. As I said, pretty much all of the hard work and infrastructure has already been put in place. So it's a matter of getting focusing and getting that throughput in FY24.
So I said we had someone that we spoke to that did a site visit recently, said they looked at the mill, beautiful lick of paint on it, but minimal people around. They said it was just running efficiently, smoothly, and it just looked like it was really humming. I guess when you're putting through around that 5 million tonne mark, I guess what are the key drivers to ensuring everything's running very smoothly, minimal delays, and I guess what are your key focus points there?
Yeah, I think it's all about coordination and teamwork. It's it's a significant size operation at King of the Hills. We're currently in that order of 660 plus tons per hour. There needs to be good coordination with the mining team for the delivery of the ore and the right fingers on the ROM, the ROM loaders, loading the right blend into the crusher, and of course the processing team working their magic and delivering the gold safely and efficiently.
Mark, just on TSF5, you mentioned that sort of unlocking some greater efficiencies as well. Will any of the capital on that sort of roll into this quarter, or was it all sort of realised in the previous quarter?
Yeah, the cost for TSF5 is about $23 million, which has been expensed. Most of the expense was last year. There is some capital that will flow into April and May, but it's relatively modest compared to the overall capital.
So do you see a bit of I guess potential long-term upside based on these last couple of months? Once you've obviously shown you can get the throughput through, the grade, the grades lifted, the recoveries have lifted. I know the brokers are sort of forward looking that you're about 205 to 210,000 ounces per annum. I guess with your performance to date, do you see that you might be able to exceed that in the future if everything goes to play in your favour?
Yeah, we will obviously do what we can to exceed and break records, but really what we're targeting is to under promise and over deliver. So we want to be a sustainable long term circa 200,000 ounce gold producer, and that's what we're targeting at the moment.
Too easy, Trav. You got anything else, mate?
I guess I'm just I'm looking at the hedge book, and it's sort of like, I think it's so important when the focus on production you have, right? It's like you need more ounces, because otherwise the hedge book represents a greater proportion of your overall production, and you don't get to realize that those high gold prices on just like when your average realized price. And I think that just becomes pretty clear at the moment. So I mean, we're looking forward to continuing to watch the turnaround take place. Mark?
Yeah,
thanks very much, guys. Really enjoyed talking to you both today.
Too easy, mate. Righto, Mark. Well, thanks very much for coming on, mate. And so we hope you, as I said, we hope for everyone in Red 5, you keep delivering these good months, mate. It's be a great little turnaround story. Everyone wants to see it. So best of luck, mate, from all of us here.
Thanks, Matt. Cheers, guys.
Oh, there you go, Trav.
Hey, mate.
Mate, I'm sure that that probably went against your style of not grilling the hell out of MDs, but it's good to be alongside this story if they can turn around. It sounds like once everything's humming and that debt's paid off in however long that's going to be, a few years or something, you'd hope it's a good bit of a good free cash flow generating business.
Yeah. I think the strategic value of the mill, like, not to be understated, but yeah, like the interim period of time until any regional consolidation, if it happens, is just all the focus is just going to be on balance sheet. Yeah,
I think, and you could see if they can get through this next few years, because you see the hedge book finishing Q1 FY27, so 3 to 4 years and debt paid down.
But look at that hedge book, right? So the hedge price in FY27 is actually okay. Like, those ounces are hedged at 2,800.
Yeah, and look, who knows where the gold price is going to be? But you'd if it's in 4 years' time, you'd anticipate it's going to be higher than 3,000, possibly.
Oh, who knows? Mate?
Who absolutely knows? And costs will be high. So you just come that 27 if they can get the debt paid down, unhedged, pumping out 5, and if they expand it up to the 5.5 million tonne per annum, should be a good little.
I think they've got like a good chunk of capital throughout the mine life as well. So there's like consistent cutbacks and things like that. And I think you know, that dynamic puts extra stress on the balance sheet, not just the ramp up bit. So like the interplay of the capital, the the balance sheet and production is going to be one that people keep watching. But it is really good to see 2 consecutive or a few consecutive months here of improved monthly production greater than the market's expectations, and it looks like they're past that minimum cash balance. Because you're just worried that they're going to have to issue new equity, and you hope that doesn't happen again. But it looks like they could be past that.
Yeah, and as you said, he played it with a straight back. Says there wasn't past that point, so let's hope that is the case.
He said, cash has been growing month on month. So yeah, let's hope that trend continues.
Very much so, mate. Righto, money miners, have yourselves a bloody sensational weekend. Another week down. JD returns Monday. Is he going to be here Monday?
He's here. He better. I think he is. Yeah,
fucking better be.
I think he is. I plan to take the day off, so because he's
me too.
Back on.
JD, it's his turn to learn how to edit. Pressure's on the big fella. He's going to absolutely flip out. We'll just me and you'll walk out and go to the pub for lunch. We're like, right,
beers
so if anything's late next week, it's because JD's learning how to edit. So, right, God, he's lucky he'll be back here to defend himself. He could stand over there too. I like this new spot.
It's beautiful.
Beautiful, mate. Righto. Trav, thanks very much for the week, mate, as always.
Mate, the last 3 weeks with you have been a pleasure.
3 weeks. Have they had like one blue?
Yeah,
2?
only one.
One?
Yeah.
But that's pretty good for 3 weeks, I reckon, for bloody highly.
It's better than most
both intense business people. Or two, we think we are anyway. So I reckon one was pretty good. I would have bet a couple more.
I know.
Right, money miners, have yourselves a safe weekend. Stay off the darts, and we'll see you next Monday. Hooroo.
Hooroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.